see a pause here. I mean, I don't know how much of a pause we need to just let those moving averages catch up a little bit, but some sideways action, even a little bit of a downtrend. I mean, that was the thing, is I was hoping on July 8th, when we had that one day, that would be a little bit more. And then this one was at least a few days down. But the big question is going to be, was it enough?
Mm-hmm. And Ed, with it being such a big week for earnings, I mean, that could definitely impact the market direction and where we're headed if all the big tech names move together, or just there's a shift in sentiment. What are your thoughts on that?
Yeah, I mean, it's like you could really move the market with these, and obviously individual stocks could have big moves. I think stocks like Facebook and Google could really have impacts because they were driven up by Snap and Twitter. So to a certain extent, how much better can the news be? I mean, so some of that, they're obviously expecting good news. And that may be good. It may be a really strong report, but there might be limited upside on something like that after such a big move. I mean, I don't know. So I think investors should I would think that they should be cautious at least until we get on about making further new purchases. I mean, there was a lot of good buying opportunities last week, but it seems like just for individual stock reasons and for the overall market, with the market extended a little bit, with so many earnings, there's still not a lot of great breadth in this market. That it just sort of feels like you might want to just not take a lot of new action for a couple of days. I mean, obviously, if the market flies, you'll be happy if you bought more stock today. But it just seems like maybe in this environment, because we had basically maybe 2.5 days of going up on the advanced decline line, that solid blue line that you're showing there. And then the same came back down. I mean, we were basically at 6-month lows. So a rally we're sort of getting that issue of like a week and a half ago where the rally's extended, but the breadth is really not very great, though. The real difference is that leading stocks have performed better. That was the real shift from a week and a half ago. Leading stocks are looking good. So, I mean, there's no real reason to be bearish. I just don't know if you want to extend yourself for just the next couple of days.
Yeah,
Right.
it's not one of those where let's get on margin, let's do pedal to the metal, because again, what we were doing on Swing Trader and what I was doing personally was I was selling some into the strength. And Scott, while you were gone, you were quoted often. The ducks are quacking, type thing. And I mean, it was just again, it was a very good week, and so I wanted to sell some into the strength.
And Ed mentioned extended. Well, what do we mean by that? Well, QQQ, which tracks the NASDAQ 100, finished Friday some 6.7% above the 50-day line. Before the last pullback, it was right around that level, but it is a big week for earnings. Scott, you often talk about this jealousy factor and how stocks that you want to own, how they're performing in the market, that impacts your outlook. How is that jealousy factor shaping up right now?
Yeah, I missed a lot of good bounces. I missed everything. I was glad, first few days the market was down. I thought genius, because I always lose on vacation. So I was pretty much cash. I had a few positions that I didn't want to get rid of, but they went down and it didn't impact me. It wasn't enough to bother me either way. But then the market roared back, and I just kind of watched from afar. So, the only thing I'd say is everybody and their mother knew the breadth was bad. So then the breadth being bad was not a good indicator anymore.
Mm-hmm.
I don't know what it is about the market, but the information flies in so fast that all these old school indicators we used to use, they don't work anymore, at least not right now. So you can see the breadth has been bad for months and months, and the market has just been hold my beer. It just goes up. And the pullbacks are never enough for guys like myself.
Right.
The old adage, everyone wants to buy a pullback until it pulls back, I'm not in there buying that pullback right there, right? The market's gapping down and you're just like, whoa, maybe something's wrong. So it never does it enough, which is why it feels like a lot of people are trapped on the outside looking in. Everybody, and I use that term loosely, of course, everybody, but a lot of people are underinvested, including myself. But I'm okay with that. I have one client, and so far in 25 years, he hasn't fired me yet, although he should have many years ago. There were a few years he should have fired me. So I just live with it, and I'll wait for the right setups. I'll be patient. There's a lot of cross currents, so I agree with the guys. There's no reason to be aggressive here.
Okay, well, we opened up the show with should I stay or should I go? Since it's a week of earnings, Tesla, one of the first on the block here with earnings out tonight. Let's talk about this, but also I think, Justin, just in the context of you can apply this to other stocks in your portfolio. What are some of the things that investors should be thinking about when it comes to either holding a stock that they own into earnings or selling it to reduce their risk?
Well, I mean, the number one consideration I always think of is how much cushion do I have? Because the last thing I want to do is risk a lot of my personal capital. And so if I don't have much cushion, and I know that there's a risk of the stock making a big move on earnings, that's just the way it is. So I don't want to put myself in a position where I could be looking at a big loss on a company. Now, if it's one of those things where I have a 10% cushion or more, and even if the stock is down 20%, then okay, now I've lost 10% of my capital and I can cut my loss and move on. But I don't want to get to a position where I didn't have any cushion and I'm down 20%. So again, my first consideration is the cushion. Then sometimes what I'll do is I'll check. Hey, what were the past earnings like? Is this one that tends to surprise? Is this one that tends to go up? Is it one that tends to go down? How volatile is the move typically? And one of the things you can do as guidance for that, Gavin McMaster, our options writer, has been doing a lot of things on calculating the potential earnings move, how to get a gauge of what that range might be by using the options. Again, that you're just kind of looking at the implied volatility of the options to kind of calculate what kind of move might be possible. You take the nearest expiration after the earnings, and then you just take the at the money call premium plus the at the money put premium, add that together. Some people will adjust that a little bit, maybe do a percentage of it, or you can just take that full amount, and that gives you the price movement, and then you just calculate a percentage move from there. So that's another thing that I'll do to kind of get a gauge of, okay, now that I know how much cushion I have, is this something that if it falls within its range according to the implied volatility of the options market, how would I do? And remember that options range is plus or minus. So
exactly.
As much as it can, it can go up, like that, but it could also go down. And another thing you can do is look, how often does it fall within that range? Gavin did a thing where he was looking at historically with a lot of the bank stocks when they were coming out. There were some that had been 6 of 6 falling within their range in the last 6 quarters. I think Wells Fargo was only 3 of 6. It was falling outside of that range a lot of times. So again, that's something that's, I think, useful information. But again, it depends on how deep you want to go into it. If you just want to do the easy thing, you can okay, I'm not going to hold through earnings unless I have a big cushion. And then you can always buy it back.
Right. And for people wanting more information on the strategy, looking at expected move, Gavin has written articles on this. You can go to investors.com/options. And we can also, guys, if we could, link to that article in the description of today's show in our Q&A right now. That would also be great. Okay.
Maybe we do that every day for this week, right? With earnings.
I think that would be great.
So
I think that would be great.
Make sure people don't miss it.
Yes. Okay. So now that we've kind of set the stage for that, what do you think about Tesla here, Ed, the technicals? It doesn't look like it's really in a position of strength this moment. If you bought any time recently, since the stock retook its 50-day line back in late June, maybe you're flat on the position or so. But how would you be handling this stock heading into earnings tonight?
look, I think with Justin saying, like, there's basically no cushion or maybe even down. So it just seems likely to would want to reduce the exposure at the very minimum. I mean, it's your own investing style if you're really willing to roll the dice, because because people might think, well, it's a 50-50 chance it'll go up or down. Well, it's actually worse than that. Okay, well, how can it be worse than up or down? Well, it could go up, which is good. You could go down, which is bad. But what if it goes up to 700 and you hold it? Hey, it's great. Or even you add, and then it reverses. Well, then you're down. Or what if it falls to 600, you sell out, then it reverses higher. So I actually think that with earnings, while it may seem like a 50-50 chance or something, it could actually be worse than that, because this is the way.
Is that like the 00 on roulette? You know?
Yeah, something like that. I mean, it's just sort of like one of those things that can shake out. But I mean, no, it's not like, I think if it, to me, it's like, wait, like if it's not an earnings options, which